Good morning, Daily Hunters, and welcome to your Wednesday, October 8th edition of The Daily Hunt. We've got a busy morning for you folks with a significant amount of fresh data to sift through. Our AI has been crawling through tons of posts, revealing quite a few different stocks sparking conversation.
That's right, Ethan. It's a mixed bag, really. We're seeing some familiar names with consistently high engagement, but also a number of new tickers popping up. The sentiment, it's all over the map. There are definitely some hot candidates attracting a lot of speculative interest, but for every potential growth story, there's another that screams high risk.
Absolutely. It feels like the community is brimming with both optimism and a healthy dose of caution today, which is always an interesting dynamic for our market commentary. Let's kick things off with Poet Technologies, symbol POET. This one is just buzzing with over 500 hot leads. The community is incredibly bullish, Brooke, especially after news of a $75 million investment. People are calling it the next big thing in AI connectivity, talking about revenue inflection and riding it to the moon. The sentiment score is super high.
Well, Ethan, while the excitement for Poet is undeniable and frankly a bit contagious, the KPIs tell a different story. Our AI analysis shows a consistent stay away rating, even from yesterday. The company has a net profit margin of 0, negative earnings per share, and a seriously high debt-to-equity ratio of nearly 15. Plus, that price-to-book ratio is over 13. These aren't just red flags, they're crimson banners. It sounds like market hype is overshadowing very real financial struggles, no matter how exciting the AI prospects seem.
I hear you, Brooke, but sometimes you have to look beyond today's numbers for tomorrow's breakthroughs. This $75 million investment could be a game changer, giving them the runway they need. But fine, for now, the AI insight on Poet, P-O-E-T, despite the overwhelming bullish community sentiment, leans towards a stay away. It's just too speculative for fundamental investors.
Moving on to Archer Aviation, ACHR. We saw a spike in activity here, largely driven by those Tesla eVTOL rumors. It was a stay-away rating yesterday.
Yeah, and the community was really riding that wave of Tesla eVTOL buzz. They thought it was the next big thing in air taxis, but those partnership rumors ended up being a nothing burger, as some users put it. Still, the underlying tech.
Underlying tech is one thing, Ethan, but the fundamentals are another. The AI's analysis gives it a strong bearish sentiment, and for good reason. Archer has negative earnings per share of negative 1.27, a 0 net profit margin, and a debt-to-equity ratio close to 5. Plus, that beta is over 3, which screams volatility. The Nothing Burger news just highlighted how much this stock relies on speculative catalysts rather than intrinsic value. So, Archer Aviation, ACHR, remains a stay away.
Okay, from speculative to something more grounded, let's talk NVIDIA, NVDA. This one has been a roller coaster for us, Brooke, from stay away to cautious buy yesterday. Today, the sentiment is overwhelmingly bullish. People see NVIDIA as the benchmark for success in AI. Our AI even tagged it as buy in one analysis, but stay away in another due to high valuations.
Well, a closer look at the most recent deep dive for NVDA, the one challenging the bear case, actually highlights impressive performance. While its PE and PB ratios are high, and the debt-to-equity ratio is also up there at over 10, it's still showing phenomenal revenue growth over 55%, a net profit margin above 50%, and return on equity north of 100%. These are truly standout figures reinforcing its pivotal role in AI. So for NVIDIA, NVDA, based on these robust fundamentals driving that growth, our AI insight is a buy today.
Now for another giant, Amazon, AMZN. This stock continues to show incredible strength. It was a buy yesterday, and the community is super optimistic about Q3 earnings, especially after the de minimis rule termination impacting competitors.
And the KPIs largely support that bullish sentiment, Ethan. Amazon shows solid revenue growth of over 13%, a healthy positive EPS, and a manageable debt-to-equity ratio. Wall Street is betting on their AI and cloud comeback, and frankly, the numbers make sense. Plus, it's trading with some room to run before hitting its 52-week high, giving it that little extra upside potential. So Amazon AMZN retains its buy classification.
Let's pivot to United Health, UNH. This one has had some ups and downs, Brooke, from buy to stay away in past analyses. But today, the sentiment is positive, with users seeing it as a long-term, stable investment even amidst market volatility.
And for good reason, Ethan. The latest deep dive for UNH is a clear buy. It has a very reasonable PE ratio of under 16, especially for a company of its size and stability. Wells Fargo just upgraded its price target significantly to $400, maintaining an overweight rating. That's a huge vote of confidence. Its low beta of 0.478 also makes it a defensive play in uncertain times, aligning perfectly with the community's will be okay sentiment. United Health, UNH, is a buy.
All right, let's quickly look at Tesla, TSLA. It was a stay away yesterday, and honestly, the community sentiment is quite bearish today, predicting a market top and economic collapse.
And their concerns are well-founded, Ethan. Despite the personal success stories some users report, Tesla's PE ratio is still ridiculously high at over 200. Compounding that, it's showing negative revenue growth and a high debt-to-equity ratio. These are not the hallmarks of a stock ready to weather a downturn. So Tesla, TSLA, remains a stay away.
Finally, Opendoor, OPEN. This has been a frequent stay away for us, Brooke. The community is still quite bearish, with comments like Open stole my soul after past negative experiences.
And for good reason, Ethan. The company is fundamentally unprofitable with negative net profit margins and EPS. That debt-to-equity ratio is an astronomical 366, and its beta is nearly 3.6, making it extremely volatile. This is a very high-risk play without the underlying financial health to support it. Opendoor, OPEN, is definitely a stay away.
All right, Daily Hunters, here are today's top candidates for you to dig into further.
Remember, these are based on our AI-generated insights and market commentary, not financial advice. Do your own due diligence.
Investigate as buy. Amazon.com Inc., AMZN, United Health Group Incorporated, Common Stock DE, UNH.
Investigate as cautious buy. NVIDIA Corporation, NVDA.
Investigate as speculative gamble. Poet Technologies Inc., POET. And that wraps up another episode of The Daily Hunt.
Just a quick reminder, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions.
We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset. Also remember, the data we use is from the previous day and could be outdated. Always do your own thorough research.
Thanks for tuning in, everyone. We'll catch you tomorrow morning with more fresh insights.
Happy hunting!